Hello, everybody. Welcome to another edition of The Productive Attorney. My name is Jim Zeta. I'm your host. The Productive Attorney is a podcast where we talk about things that can make you more productive as an attorney within the practice of law so that you can enjoy the things outside the practice of law that you like to do. Today, we are going to be talking about tax tips for lawyers. Many of these I've learned the hard way, and many of these I've learned from friends or gone through the process. I will sprinkle in stories as we go through, and as kind of as an example throughout, I'm going to be using an attorney who makes $120,000 a year as kind of my primary example, and then which is $10,000 a month, and that way it's kind of the baseline for what we do for all our tips. And there's about 15 of them in here, so I'll rip through them real quick. So first thing is the very basic one. I teach this in my class for students who really haven't made money in the real world yet, and they don't quite get this one yet, but it's about tax brackets. So for example, when you're making $120,000 a year, you are in a tax bracket. I think currently that's a 24% tax bracket. And so 24%, that means that the money, the $120,000 you make is at 24%. But what lawyers have to understand is, hey, some lawyers have said, well, I don't want to make it up to the next tax bracket. So let's say the next tax bracket is 28%. I don't want to make $150,000 in the 28% tax bracket because then all my money is going to be taxed at 28%. That's not true. The 28% tax bracket simply means that when you get to that tax bracket, the only money that's taxed at 28% is the money that is at that level or above. So let's say the tax bracket at 28% starts at $150,000 and you make $160,000. Not all the $160,000 is taxed at 28%. Only the $10,000 between $150,000 and $160,000 is taxed at 28%. The lower amounts are taxed at the lower tax brackets. So effectively, when you're making $160,000, you're not paying 28%. You're paying 0% on the first $10,000, and then you're paying 12% on the next $25,000, and then you're paying, and up as it goes up, and effectively your tax rate is much lower than the 28%. So the bottom line is, don't worry about it. If you're out in the real world and you look like you're going to get to the next tax bracket, be happy you make it the next tax bracket, but don't avoid making that money because you think you're going to get paid more or have more. Second is, for another simple tip for lawyers, when you're an associate or you're in a place where the payroll is being done for you, you get your check at the end of each month, and let's do the $120,000 a year lawyer, $10,000 a month. That's your gross amount, but then the firm is taking out FICA and payroll taxes and all the other things that they take out of your check, and you bring home $7,000 a month after all those deductions. You get used to your $7,000 a month check. That's what you get. Then you make partner, or you own your own firm. But mostly it's your partner. And your income increases. Hey, you made partner, we're increasing you 50%. You're up to $180,000 a year, which is $15,000 a month. You're like, that's so exciting. And the firm gives you a check for $15,000 each month as a partner distribution. Well, there was a partner who got that $15,000 at the end of each month and just put it in his checking account and spent it. And at the end of the year, he comes to his CPA, and the CPA says, okay, Mr. Partner, you're a 25% tax bracket. That's just for discussion purposes. So on $180,000, that's $45,000 in taxes. Mr. Partner, where's your check for $45,000? And he said, what do you mean? I was getting $15,000 a month, and that's what I was making. Well, no one took taxes out of that. Well, I didn't know. Wasn't the partnership supposed to do that? Wasn't the firm supposed to do that? No, knucklehead. That's up to you. If you become partner and you start getting distributions, or you get large chunks of money from the firm without taxes being taken out, it is your responsibility as the attorney to tax plan, to take the money, to set the money aside. Typically, of any kind of money that I used to get when I was in that situation, is I would have a separate account in my bank. I called it my tax account. And when any time I would get a distribution from myself as a firm or the firm that was not taxed, I would personally take out 30% of that money and put it in the tax account. And I figured that was no longer my money. And then when my CPA came to me at the end of the year and would say, like in the situation of that partner, where's my $45,000? Oh, it's over there in my tax account. I'll go ahead and transfer it to my operating account, my checking account, and I'll write you a check. Third tip, if you have a little side business, I just talked to a lawyer yesterday who had a voiceover side business. I was a soccer coach. Any business that brings in any sort of income, and doesn't have to be a lot, you can go ahead and take off your expenses associated with that income through a Schedule C. So, for example, on your tax return. So, for example, I was a soccer coach and I was bringing in $300 a month. That's how much they were paying me. Now these coaches make a whole lot more. But then I was $300 a month. So that's $3,600 a year. But I would buy the kids shorts, I would buy soccer balls, I would buy cones, I would buy pennies, I would buy all these things. And I would often help the kids pay some of the fees or the tournament fees for the kids. And really it ended up being a situation where I was losing money. So let's say I brought in $3,600, but I spent $4,600, and I had a $1,000 loss. Well, that's what the Schedule C is for. You can go ahead and write those expenses off against the $3,600. So not only do you not have to pay taxes on the $3,600 you got for coaching, but you have a $1,000 loss that you can then apply to your lawyer income and have a loss. IRS doesn't look kindly if you have a Schedule C with losses year after year after year. So maybe at 1 or 2 years you got to show that you make money, but that's perfectly ethical and legal to do if you're making money on the side. The fourth tip is bonuses or large chunks of money if you're not used to getting them. My associates are paid bonuses from time to time, but they're also paid out of settlements if they brought a case in. So on a contingency fee case, if an associate brings a case in, I give them a certain percentage of that contingency fee as an origination fee, as an incentive for them to go out and market and continue to bring cases in. When they're large cases, the associate gets a large chunk of money. The question for the associate is, do you want it to go through your payroll, or do you just want the money in full to you? And originally my associate was getting money in large chunks, but I wasn't taking any taxes out, and I told the associate that it was his responsibility on those taxes, and he had to plan, and he could have done the same thing I talked about at setting money aside in a tax account, but eventually he told me, no, just give me go through payroll on the big ones. That way I don't have to worry about it, and so that's what I've done. Just be aware of that when you get large chunks. Number 5 on tax tips. If you're running your own firm and you pay the payroll by yourself, in other words, you calculate it and then you submit money to the IRS for the payroll taxes. I have a service called Paychecks. There's ADP, there's other services out there that do that for you. But if you're doing it on your own, there are attorneys and business owners who are tempted to take that money that they are supposed to send to the IRS for payroll taxes and use it for business expense or personal expense and say, I'll pay the 941s when I get a chance. I just use it like any other business debt. No, don't do that. The 941 liability not only comes to the firm, but it comes to you personally, and they can get a personal tax lien against you. And the IRS is like the big elephant. Wherever they want to sit, they get to sit. And if whatever lien they want to take, they take. Whatever money of yours they want to take, they take. Pay your 941s. The 6th tip, primarily for plaintiffs' attorneys who do, or anybody who does contingency fee work, has to do with case expenses as the case is ongoing. Very interesting to me subject because there are so many nuances to it, surprisingly so. Here's the primary example. And let's look at this in a vacuum. I'm in a situation where I have a case and the case settles and I get $500 for that case. So my firm has $500 worth of income in 2022. and I'm going to have to pay taxes on that $500 in income. But then I have a new case, and I want to file the lawsuit in the new case. And that new case has a filing fee, and that filing fee costs $500. So I take the $500 I made from the old case, and I use it to pay the filing fee for the new case. End of the year comes up, and I have to tell the IRS I made $500, and I have to pay my 25% taxes on that. That's $125. And the IRS comes to me and says, you owe $125. And I say, I don't have $125. I spent all my money, the $500, on that filing fee. And the IRS says, tough luck, that you cannot expense that, you cannot deduct that $500 until you resolve the case. I say, well, I may not resolve the case until 2024. And the IRS says, tough luck. And you say to the IRS, I have no money to pay you the $125. I already used it. And the IRS says, tough luck. That's the definition of phantom income. That $500, I got the income in, I use it as an expense. I have no income. I have no money. Yet the IRS considers me to have income, so it's phantom income that I have to pay taxes on for that. The idea as a plaintiff's attorney is you are not allowed to expense those case expenses until the case is resolved. That's just simply the rule. You are tempted and you want to be aggressive and expense those during the year you get the money in. That only makes sense and that only seems fair. That's not the case. I will say there was a case out of the Ninth Circuit, United States Ninth Circuit Court of Appeals, which includes, I believe, California, Oregon, and Washington, which gives an attorney in those three states an argument to the IRS that they can deduct those expenses as they incur them. But I will tell you that there's a United States Fifth Circuit Court of Appeals case that's opposite of that. So that's Texas, Louisiana, Oklahoma, places like that. And so you can't do it. You just have to carry those expenses. One more tip on, and this isn't necessarily a tax tip, but one more tip on that is I've got a huge amount of case expenses. And there are finance companies out there who will say, look, you have $100,000 worth of case expenses for all your cases. We'll loan you 25% of that money. We'll loan you $25,000 to do what you want. And then as those expenses come in, you just pay us back that $25,000. Plus we get interest. That's how they make money. And so you can use your case expenses to get a loan or a line of credit. I've never done that. I'm super conservative when it comes to that. So that's that tip. Next tip, estate taxes. So you're going to die. We're all going to die someday. And we're going to have to pay, our heirs will have to pay taxes on our estate if our estate is large enough. What is the limit? Right now in 2022, it's $11 million. Most lawyers, most people don't have a net worth of over $11 million. If you do, you need to get sophisticated estate planning. But that number, that $11 million shifts drastically and has shifted drastically throughout my career. It has been as low as $1 million. But also there was a time one year when there was no estate tax. And so people who died during that year, their heirs did not have to pay taxes. And so there were some billionaire children who benefited substantially from their billionaire benefactor, billionaire person dying that year. So just be aware of the estate tax limit. Just watch it from time to time. Next tip, maybe a little bit, some people feel differently about this next tip. You get in a client that comes in and you get a fee, and that fee is $15,000, a flat fee, and they come in with cash. Okay? What do you do with that cash? Some people are really worried to take it to the bank and give it to the bank, unless you've earned it. It's a flat fee that you've earned right then. Some people don't want to take $15,000 to the bank and give it to them because you have to fill out a form that shows a $15,000 transaction. And no, people say, well, I don't want the government to know what I do. I don't want to be on the government's radar. People who are smart are the opposite. They want to be able to deposit that $15,000 into the account and fill out that form. And when the IRS comes back and says, well, you have a cash basis business, we believe you've been skimming off the top. We believe that you've been taking cash into your pocket and only reporting some or none of it. And you just say hey, I sent you a form. Here's all the forms that I did. I've deposited tens of thousands of dollars of cash and notified you of that. If I'm skimming, why am I letting you know about all this cash that I'm bringing in? And so I'm of the opinion that if you get more than $10,000 in cash, go ahead and deposit in the bank and let the bank fill out those forms. That's my opinion. There's a big debate about, for tax purposes, what type of entity do you use? Some people I know simply have an assumed name, and they just let the money flow through into their 1040 under your normal IRS tax return, and do it that way. I have an S corp, which is a corporation. An S corp means it's a flow-through entity. So while I do a tax return for my corporation, the income or loss will flow through onto my 1040 tax return, and I feel like that's strong. I think a CPA can help you decide that. The advantage of having an S corp, really, as an attorney, is not that much. I have debates with my friends about this. When you get sued for malpractice, it doesn't matter whether you have a corporation. If it's a DBA or an S corp, they sue you individually. They can come after your individual assets. So then what would be the benefit of a corporation? Really, it comes down to vendor liability. As you have a firm, you have vendors, and if they sue the firm, they can only sue the firm and not you individually. So if you have a firm where you have a lot of vendors and there's a potential at some point that you're going to have vendor liability issues, that's really all it comes down to. Another very basic tip I've seen on numerous websites, but it makes sense and it really is helpful. As you get your receipts for your medical expenses or your charity expenses, scan them as you go, digitize them. I have a folder on my computer for 2022 taxes, and in that I have a folder for personal and a folder for the law firm. And if I have if we go ahead and do through the credit card, we go ahead and do bits and pieces of charity contributions, I just scan that credit card statement in, and any receipts that we got for the charity, I have a separate Excel spreadsheet where I write down the date, the entity, and that we contributed to, and the amount. And at the end of the year, I have a full list that I can send to my CPA, and I can send them the receipts if they want to see them. Most of the time, they just want to see the Excel spreadsheet and know that I have the receipts to back it up. It's something that if you do as the year goes on, as opposed to putting them in a shoebox somewhere, it makes it so easy at the end of the year if you do it that way. You have to be disciplined about it, but in my world, it makes it really good to scan as you go. Same with medical. Any medical bills I get, any medical bills I pay, I throw in there. Now, I will tell you the standard deduction under the IRS is so much higher now. So that's the deduction you get if you don't itemize. And it is so high that we rarely meet the standard deduction with our medical expenses and our charity expenses. Knock on wood on the medical side. So that's another tip. Another tip is get a good CPA. CPAs can cost a lot of money, but they're worth every penny. The one that I have, he's amazing, and he's worth every penny. I will tell you that I did interview with a CPA and just talk with him, not so much to hire him, but he was a CPA that some people I knew use, and I just was in a meeting with him, and he made a comment that your 1040 tax return is simply your first offer to the IRS. That the IRS, that you can go ahead and be aggressive, and this is your first offer. That CPA is now in jail, literally is in jail. So it is not your first offer. It's not something to mess around with. And what a CPA can do for you, especially in this time of pandemic. Everybody had a home office during the pandemic. Everybody used their home as part of an office. How much of that house can you deduct? CPA can help you with that. Another tax tip, I have 2 credit cards if you have your own firm, or even if you don't. Have a credit card for business expense and have a credit card for personal expense. And that way, when you go out on business, you can use that business credit card, and you know when that bill comes in, you write it off, or you write it through your business, or you ask for reimbursement from your firm. You have that set aside, and anything on your home credit card, you know it's your personal, and you pay that. That seems to work for me. Another tax tip, and this I can't emphasize enough: if you have a trust account, your trust account must be perfect. It must be spotless. If you have an issue with a balance issue in your trust account, keep in mind that is not your money, and you are messing with other people's money. And I always think of it: when somebody gives me $20 to do something with, I know that I'm their trustee of that $20, and I will make sure they get it back, or I tell them exactly what happened to it. Well, that's IOLTA, and you cannot have an issue with that. And years ago, when I was doing mass tort work, we would have lots of cases, and we would have a settlement that would come in, and that settlement would be dispersed among 1,000 clients. And we ended up having a problem with our trust account where it wasn't balancing correctly, and we couldn't figure it out. I ended up spending $50,000 on experts to come in and to get it rebalanced. And what we ended up determining was there was a coding error in the case management software, to such an extent that we reported the coding error to the case management software company. And this was a state-of-the-art case management software. This was many years ago. And they came back and said, "You are right, we have a software error," and they discontinued that software. That's how extensive it was, and how much research I did to get to the bottom line on that. It was worth every penny of the $50,000. I hated it. It sucked. It wasn't my fault, but I got down to where I knew where every penny of every client's account was. Don't mess around with your trust account. Always know where that money is. Never take money out of your trust account that doesn't belong to you. You just can't. The stories of lawyers who have pilfered their trust account are legendary, and the things that have happened to them are also tragic. So keep your IOLTA account perfect. Make sure that when you're taking out money, loans from your own firm, or distributions from your firm, or you have equity that belongs to you in the firm, keep track of that. If you don't keep track of your equity, loans, and distributions, it can become a mess for your CPA. It can become a mess for yourself. Another tip: if you own your own firm, you have to go ahead and send out 1099s on behalf of people who have paid you certain amounts of money. So, and I think it's $600 or more. If you have vendors that have sent you money in of $600, or you have certain people that have sent you in $600, look at the rules on who has to get one. But I think this year I sent out almost 100 1099s. There's a lot of 1099s you have to send out to people, and sometimes people don't like getting them because that means they have to tell the IRS that they got this money from you, but that's your responsibility. So make sure you fill out and file your 1099s. This next tip is basic, but everybody should do it. You can reduce your income by going ahead and contributing to an IRS qualified retirement fund. So 401k, Roth 401k, there's all kinds of vehicles out there that you can use to contribute money that then you don't have to report that as income. The advantage, like in Texas, for example, the other advantage of having an IRA or having some sort of IRS qualified retirement account is that is free from creditors, that is free from judgment creditors. So, if you have a IRA, 401k, IRA or 401k, they can't get it. If someone sues you for legal malpractice, wins $1 gazillion, your retirement fund is protected. That cannot be, they can't get to that. It's exempt from judgment. That's another reason to have it. Also, look into your tax benefits for employing your children. There are certain benefits for employing your children. I've employed my kids. They are much smarter than me on computer. They're much smarter than me in marketing. They've given me a lot of tips over the years. Look into that. Another thing you might want to look at if you're doing your taxes on your own, do the calculations. If you're married, do the calculations of married filing jointly and married filing separately. Occasionally, not very often, but occasionally on the married filing separately, you can pay less taxes, and obviously ethical, legal, and see if that works for you. And then my last tip is don't be stupid. You know in your heart that when you're doing something that is messing with the IRS, that you know you're trying to screw them, then you're eventually going to come back and get you. Most people can get away with it. The IRS right now is underfunded, and they're not doing a lot of audits, and you can get away with it, and there are a lot of people who have gotten away with it. But do you want to be that 1% that gets audited and you're having trouble sleeping when you get that letter from the IRS saying that they're going to audit your taxes, and you get somebody focusing on you, or someone goes out and reports you to the IRS and says you're not paying your taxes? Because everybody out there has someone who probably doesn't like them, and they can go ahead and make a complaint, and the IRS can look into it. And I've had that happen to people too before. And the other kind of example of don't be stupid is there's a case out there where a lawyer who was a tax attorney got a yacht, and he named his yacht 1040. Pretty clever, right? 1040 is a tax return, so he named his yacht 1040. But he deducted his yacht. He deducted it as a marketing expense, and a yacht is not a marketing expense. And the IRS came in and audited him and made him pay back the tax savings that he had for using his yacht as a marketing purposes, and obviously gave him penalties and interest. So don't be stupid. I guess that's the best way to leave it off on taxes, is just pay your taxes, calculate them, figure out the way you can pay the least taxes legally, but then pay them. My name's Jim. That's my tax tips for lawyers. Have a great week.